Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Sam. Hi Alan, I have a question regarding the setup of the poor man's covered call following your strategy. Based upon your entry conditions, I find it very hard to find a setup that works unless I go very deep in the money to the 94 to 97 delta range when selecting my leaps. For example, with IBM using the 120 leaps with a 75 delta, note that the break-even exceeds the current stock price. Would you go so far in the money with the leaps? How would you set up this trade? Thanks, and it's signed, Sam. Okay, so Sam is referring to a covered call writing like strategy, the poor man's covered call. So for those of you that are not that familiar with the strategy, let's give an overview of the strategy before we get into the specifics of Sam's proposed trade. Now, the poor man's covered call strategy is a covered call strategy where instead of buying a stock or an exchange traded fund, we buy a long-term, deep in the money leaps option, which means an option that expires approximately 1 to 2 years out. Now, the fact that it's deep in the money means that it will have a delta between 0.75 and 1, which then means that the price movement of the option will simulate or be very close to that of the underlying stock or ETF. Against that long position, we then sell short-term options. Could be weeklies, could be monthly options. We're going to talk about monthlies in this case. And then we generate cash flow in that manner. Now, the leaps option, when we buy a leaps option, we have the right to purchase that security at the strike price by the expiration date. So, in fact, we are covered. We know our cost basis. Now, the technical term for this leaps option with the poor man's covered call is called a long call diagonal debit spread, which means the simultaneous purchase and sale of an equal number of options of the same class and underlying security, in this case IBM, with different strike prices and different expiration dates. So that is the technical definition of the poor man's covered call strategy. Now, we can't get a precise handle on the probability of profit because the implied volatility of that security can be very different from when we enter the trade to when we end the trade. So that will have an impact on the leaps value when the trade is entered. However, what our goal is with this strategy is to generate cash flow and reduce our cost basis by selling premium. So that's the thrust of the poor man's covered call trade. Now let's get into the specific of Sam's proposed trade with IBM. And I received the email contact from Sam on June 6, 22. At that time, IBM was trading at 141.35. The 120 deep in the money leaps, which expired on January 19th, 2024, so approximately a year and a half into the future, that had a delta of 0.75 or 75. Now, the cost of that leaps, the ask price on the option chain, was $29.15. So we buy at the ask, the higher price, we sell at the bid, the lower price. Now, the 150 short call, which expired on July 15th, so approximately 5 weeks out, had a bid price of $1.04. So what we do is we take this information and we feed it into the white cells of the BCI Poor Man's Covered Call calculator to get our results and to see if the trade does meet our system requirements, including our return goal range. So should we avoid this trade because of the break-even price point, which the spreadsheet, as you'll see in a minute, shows it to be 148.11. So does that mean that IBM has to move up from 141.35 up to that break-even price point of 148.11 in order to break even and higher to start making money? The answer is no, it doesn't. In this video, I will detail what that break-even price point actually means. And so we should not reject this trade at this point in time based on that break-even price point of 148.11. So here we go. Let's have a look now at a screenshot with this specific trade using the BCI Poor Man's Covered Call calculator. Now, in the white cells on the top of the spreadsheet, we see the information gleaned from the option chain. The trade date is 6/6/22. The short call expiration date, 5 weeks out, 7/15/22. The price of the stock at that time, 141.35. We're going to purchase the 120 deep in the money leaps. Remember, it had a delta of 75, which met our system requirement. And the cost was $29.15 per share. So we're purchasing the IBM at $29.15 for the option as opposed to $141.35 per share for the actual stock. Now the leaps expiration date 1/19/24, about a year and a half out, and the short call strike was 150, and the premium was $1.04. So all that information gleaned from the option chain is inserted into the white cells at the top of the first tab of this calculator spreadsheet. There are additional tabs for managing our trades, but this is the first tab for our trade, initial trade crafting, and we want to see whether or not it meets our system criteria. All right, let's move now to the bottom half of the spreadsheet and see the information gleaned after entering the information from the option chain. Let's look at the red arrows in the middle of the spreadsheet there, and you could see that if the trade was closed, if the price of IBM went to the moon, and we were forced to close the trade at the 150 strike and exercise the 120 leaps, we would generate a profit of $1.89 per share, which represents a 3.57% 39-day trade. Now, the third red arrow down shows us that the upside potential for this trade is an additional 29.67%. And that's if IBM moves from 141.35 up to that 150 strike on a cost basis of the leaps of 29.15. So there's a possibility, you know, if IBM went all the way up to the moon and we closed both legs of the trade, we would have a 33.24% 39-day result. That's, you know, obviously a fabulous result. Okay, now let's focus on Sam's concern. You could see in the blue circled area that the break-even price point is 148.11. Remember, we entered the trade with IBM trading at 141.35. So does this mean we should reject the trade because IBM has to move up to 148.11 in order to break even? The answer is no. I'm going to define for you what that break even means, and then we'll talk about the practical application. But the spreadsheet does offer a very easy way of letting us know whether or not this is an appropriate trade based on the BCI system requirements. And you could see that purple arrow in the middle of the spreadsheet gives you a big fat yes. It is an appropriate trade. I'm not telling you to do it, but is it appropriate based on the BCI methodology? The answer is yes. So that's an easy way for us to tell whether or not we can move forward with this trade. Now, that said, let's specifically talk about that break-even price point and what it means, and then we'll talk about its practical application in this particular trade. So if we sold IBM at 148.11, if it moved up to 148.11 and we sold it, we will have a break-even trade, and here's why. IBM is purchased because of the leaps option. We have the right to purchase it at 120, and if we sell it at 148.11, we're plus 28.11. Now, what did the leaps cost us? 29.15. But remember, we had the initial short call premium of $1.04. So if we deduct $1.04 from 29.15, we have the very same 128.11. And that is what the break-even price point represents on the spreadsheet. If we close the trade at 148.11, we will have a break-even trade. It does not mean that IBM must move up to 148.11 in order to have a successful trade, because look, when we do the poor man's covered call, we are planning on a long-term position with IBM, generating weekly or monthly cash flow by selling these short-term call options against that long position. Okay, finally, let's talk about the practical application of the poor man's covered call break-even price point in this particular case. Let's assume now that during this 5-week short call contract that IBM is trading at 148.11. Well, we're not going to close that trade, are we? Because we have a long-term commitment to IBM with the poor man's covered call. So we would just allow it to expire worthless because we have the 150 strike in place. So the contracts will not get exercised. We will not have to exercise that long leaps position to then sell our shares, because the option buyer of that 150 call is not going to exercise it and buy the shares for 150 when they're trading at market at 148.11. It's just not going to happen. So the option expires worthless. The shares are now selling in this particular hypothetical at 148.11. What do? We then sell another short call, but probably not at that 150 strike. We're probably going to go to a higher strike. And that's a positive for us because we're expanding the range between the buy point of 120 and the sell point of some number higher than 150. Now, we still must keep our 20%, 10% guidelines in place because the active leg of the poor man's covered call in terms of management is the short call, not the long leaps position. We will have to change that eventually as it's expiring and roll that long leaps position. That's a topic for another day. And in my material, by the way, for the poor man's covered call, it's in the book, it's in the online video course. But for right now, we're talking about the short leg, which we must keep our choices available for exit strategy opportunities, which starts with the 20%, 10% guidelines. Now, one more thing I want to say about the poor man's covered call. In a lot of venues, it's defined as covered call writing, but cheaper. You know, you saw in this video that the cost of the leaps was way cheaper than that of the stock itself. So yeah, it is cheaper, but that doesn't define the strategy. There are so many moving parts to this strategy, and we must master all of the pros and cons. Every strategy has its pros and cons. So the poor man's covered call is a covered call writing like strategy, but way, way more than covered call writing, but cheaper. So learn all the pros and cons, and then you will be able to determine whether this is the right strategy for you and your family. Maybe it will be, and maybe it won't be. But I just want you to protect yourselves by mastering all aspects of this strategy before entering even one poor man's covered call trade. Now, for those of you who are premium members, you can find the entire library of Ask Alan videos, now 198 of them, on the premium member website where you're looking at right now. So what you could do is you'll see the first 10 listed, click on that link that says Ask Alan for more videos, and then you will get the additional videos all the way up to 198. And you will be able to access each individual video. Now, on the right side of the member site, resources and download section, a little higher up than what you're seeing here, on A, if you scroll down to A for Ask Alan, you will have all the Ask Alan video topics, so you can actually access the particular information that you're looking for. Before I go, I just want to mention our two best BCI packages. I'm not going to go into detail on them, but I'll tell you where you can access videos explaining them. The BCI package is an acronym for our best and most comprehensive investment package. It has 18 components to it. which includes 6 online video courses with downloadable workbooks, 6 calculators created by the blue-collar investor and therefore found nowhere else, 5 of our best-selling books in ebook format, and a 13-month annual premium member subscription. If you are already a premium member, you want to upgrade to the package, just shoot me an email at Alan, A-L-A-N, at thebluecollarinvestor.com, and we'll make it happen. Now, our other package that we're so proud of is the BCI Trade Management System, which includes a one-of-a-kind calculator, the BCI Trade Management Calculator, which allows us to enter trades for both covered call writing and selling cash secured puts. You get your initial trade and total portfolio returns. It allows us to manage our trades for both strategies, and there are over 20 exit strategy choices available, and then get our final post-adjusted trade results and total portfolio results. It is the only spreadsheet of its kind, and it's packaged with my 8th book, which is on covered call writing and selling cash secured put exit strategies. Comes with a 28-page user guide as well. How do you get information on these packages? Go to our website, thebluecollarinvestor.com. Click on Best Discounted Packages, where you see that arrow, and then you will have videos for both of these packages, and you can access them and purchase them as well. So I want to thank Sam very, very much for sharing his proposed trade with us so we could share with the entire BCI community. And of course, I want to thank everybody out there for taking the time to listen to and watch this Ask Alan video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.